What if the most popular investing advice online is actually costing people thousands of dollars, and they don't even know it? Welcome to Financial Tortoise. I am Tae Kim. Today, we're talking about one of the most repeated rules in investing, the idea that lump sum investing beats dollar cost, averaging about 66% of the time. Sound impressive, right? 2 out of 3 times, you win. But here's what nobody tells you about that other 34%. That's where people lose real money, big money. And it doesn't happen quietly. It happens during the scariest moments in the market, when your emotions are running high and your finger is hovering over the sell button. So before you take that bonus, that inheritance, or that savings pile and throw it all in at once, stay with me. Because this decision can seriously make or break your returns. Let's keep it simple. Say you have $10,000 ready to invest. You have 2 choices. Option 1, invest everything today. That's lump sum investing. Option 2, invest $1,000 every month over 10 months. That's dollar cost averaging, or DCA. Historically, lump sum investing wins about 66% of the time. The logic makes sense. Markets tend to go up over time. So the sooner your money is in the market, the longer it has to grow. Think of it like planting a tree. The earlier you plant it, the taller it grows. Time in the market is powerful. And mathematically, getting your money invested sooner gives it more time to compound. So far, lump sum sounds like the obvious winner. But let's flip that statistic around. A 66% win rate also means a 34% chance of backfires. And that 34% doesn't show up on a random Tuesday. It shows up during crashes, during recessions, during the moments you can least afford a loss. Let me paint you a picture. It's 2007. The market is strong. The news is positive. You feel confident, so you invest your full $10,000. Everything looks great. Then 2008 arrives. The financial crisis hits. Your $10,000 drops to $6,000, or even less, in a matter of months. Or think about early 2020, the COVID crash. Markets dropped more than 30% in just over a month. No warning, no signal, just a sudden, brutal drop. If you had gone lump sum right before either of those moments, you'd be staring at a massive loss almost overnight. Now here's what most people say they do in that situation. I just hold and wait for the recovery. But here's the truth. When you watch your portfolio fall 30%, 40%, even 50%, something changes inside you. You start checking your account every hour. You do the math in your head. You calculate exactly how much you've lost in real, spendable dollars. And then the thought creeps in, what if it keeps falling? That thought is dangerous because it's what drives people to sell, not at the top, but near the very bottom. That's called panic selling, and it's one of the most costly mistakes any investor can make. Studies show that average investors consistently underperform a market. Not because they chose bad investments, but because fear pushed them out at the wrong time and greed pulled them back in too late. The 66% rule doesn't account for any of that. It assumes you'll behave perfectly. But we're human, and humans panic. There's another hidden danger called recency bias. When a market is near all-time highs, lump sum investing feels obvious. Everything is going up. Confidence is high. Waiting feels foolish. But those same moments, when everyone feels great, often come right before a correction. The uncomfortable truth is this. Nobody rings a bell at the top. There's no warning. The drop just happens. And if you've just invested everything you have, the emotional damage can be severe. Not just to your portfolio, but to your peace of mind. This is where dollar cost averaging earns its place. DCA isn't designed to maximize returns. It's designed to reduce emotional risk. By spreading your investments over time, you remove the pressure of trying to pick the perfect moment. If the market drops, you're actually buying more shares at lower prices. And because you're not fully exposed all at once, a sudden dip doesn't feel catastrophic. Here's a real example. 2 investors both have $12,000. Investor A puts it all in during January, lump sum. Investor B puts in $1,000 every month, DCA. In a straight bull market, investor A probably wins. But in a volatile year, where prices drop early and recover later. Investor B comes out ahead. They bought more shares during the dip. And more importantly, they didn't panic and sell because they always had more money coming in. That sense of control is powerful. Here's a simple framework. Lump sum might be right for you if you have a long investment horizon, 10 years or more. You've lived through market crashes without panicking. You genuinely trust the process and can handle seeing your portfolio drop without flinching. DCA might be better if you're newer to investing. You're anxious about market timing. You know deep down that a sudden 40% drop might cause you to make emotional decisions. And if you're somewhere in the middle, there's a hybrid approach. Invest 50% right now and spread the remaining 50% over the next few months. You get early exposure to potential growth, but you also protect yourself from going all in at the worst possible moment. It's not mathematically perfect, but it's realistic, and a realistic strategy you stick to will always beat a perfect strategy you abandon. Here's the truth about investing that nobody wants to hear. The best strategy isn't the one that wins most often on paper. It's the one you can actually stick with when things get hard. An investor who stays calm and stays invested will almost always outperform someone who had a better strategy on paper but sold in a panic. So before someone tells you to just dump everything into the market right now, ask yourself one honest question. If my investment dropped 40% next month, what would I actually do? Not what you hope you do, what you truly do. Your answer will tell you everything you need to know about which strategy is right for you. Investing is a long game. The goal isn't to win in year one. The goal is to still be in the game 20 or 30 years from now, consistent, calm, and moving forward. If this video helped you think differently about how you invest, please give it a like. It really helps this channel grow. Drop a comment below and tell me, are you a lump sum investor, a DCA investor, or somewhere in between? I'd love to know. And if you haven't already, subscribe to Financial Tortoise. We publish videos every week to help you build real, lasting wealth, slowly, steadily, and smartly. I'll see you in the next one.